Hi friends, welcome to Adda 24/7. We are in the BFM important questions and case studies. We are in fact covering it for all the subjects. I am covering ABM and BFM. So follow the video till the end. Share it with your friends. Share it on all your social media platforms. Here we are covering all the important questions over here and some numericals also. Numericals, you know the importance of numericals in your BFM and ABM. Okay. So follow it till the end. So let's start. Before that, subscribe to the channel, click on the bell icon. Don't forget this, okay? So move on. First question. The credit risk of the bank's portfolio depends on which of the following factors? Credit risk. Kindly note, there are three risks. Main risk. There are many risks. Main are three. Credit, market and ops, which are related to Basel. Credit, market and ops. Okay. So credit risk is related to what? All the three risks I have covered separately. Credit risk is the risk of default, mainly counterparty or the country. Credit risk is always related to the country risk and the counterparty risk. Market risk is not in your hands. It is the external factors which are not at all in your hands, like the Russia-Ukraine war or Israel-Hamas war, like that. Okay. Operations risk is in your hands. You can keep the control over it. The more mechanization, the more processes, stronger processes, you can definitely control it. So now the credit risk depends on which of the following factors? State of the economy. If the economy is down, what will happen? People like COVID. What happened in COVID? COVID, the economy was down. There was a huge credit risk. Everyone started defaulting. So state of economy, correct. Trade restrictions. Trade restrictions means restrictions given by the country. Like Taliban government in Afghanistan. It has stopped all the foreign exchanges. No foreign exchange will go out of Afghanistan. Trade restrictions. So country risk. See here, kindly remember, credit risk is always mainly consists of two parts. Country risk and counterparty risk. Mean the country is bad or the country is good or your counterparty is bad. So trade restrictions. So that is also true. A and B are true. Now let's see C. Inadequately defined lending limits for the loan officers or credit committees. Inadequately defined means your loan limits are not properly defined. Which type of risk is this? Yeah. Which type of risk is this? This risk is operations risk, right? It's an operational part. Your processes are not proper. Okay, operational risk. So this is not a part of credit risk, right? So the answer is only A and B. Got it? This is the operational part. You have to clearly define what your loan officers, what is the sanctioning power of the assistant manager, general manager, whatever it is. Okay? Which of the following statements is incorrect regarding LRM? Incorrect means negative question. Kindly focus always in the exam whether they are asking correct question or incorrect question. This is negative question. Okay. What is LRM? LRM is basically credit audit. You can call it separately. Credit audit. Again, same name. It is the audit of the bank mainly. Kindly note. LRM is the audit of the bank, not of the customer. Mainly the processes of the bank, whether they are followed or not, that is checked. Okay. So LRM aims at to identify promptly loans which develop credit weakness. So that's also true. Means what is the basis of audit? To check which loans are showing the signs of weakness. SMA 0, 1, 2. Weakness means what? Credit weakness. How will you know the weakness? SMA. Right? 0, 1, 2. Through this you will be knowing the weakness, right? It does not isolate the potential problems. It does not isolate the potential problem. Means it cannot separate the problems. To be frank, it means it cannot point out the problems. So is this true? This is false. Okay. What about C? See here. B can be the answer. So B and C or B only. Now this only B or C will be the answer. It is inefficient in providing top management with the information on credit administration, including credit sanction process. So inefficient means it does not give proper information to the top management regarding your credit admin, means whether the loan procedure is followed, whether all the securities are taken. It is not able to provide the same to the top management. Then why does it exist? If it can't provide the information, then why does it exist? So this is also false, right? So B and C is the answer. Got it? Move on. Which type of account can be opened under foreign currency non-resident account, FCNR? Now, what account can you open under FCNR? Firstly, what are the other types of accounts then? Okay, first answer this. Savings, current and savings, term deposit only, all of the above. Can I open a FCNR savings account? Or can I open FCNR current account? Or can I open a FCNR and this FD account? Yeah. What do you think? See, this is the answer. You can open only term deposit. What about others? See this. Kindly note there are three main accounts. NRE, NRO, FCNR B, we call it. Actually, it's not FCNR, it's FCNR B. Okay. So NRE can be opened via savings, current and FD. All the three. NRO can be opened saving, current and FD. But FCNRB can be opened only FD. And important point about these accounts is NRE is rupee account. NRO is rupee account. FCNRB is not a rupee account. It can be dollar, pound, Japanese yen, any, but not rupee. Kindly note this difference. Okay. Now before going ahead, everyone subscribe to Officers India Adda 24/7 English channel. Okay. Join the crash course starting on 11th October. Okay. Join it immediately. Right course, right time, apt information. Okay. Join the Mahapack also. I'll show you at the end. Everything I'll show you how to join. Okay. Let's move on with the questions. So a person wants to make an investment of 50,000 in one of the following for 5 years. Now suppose, let's say you want to make an investment of 50,000 in one of these for 5 years. Out of this, which one should be preferred solely on the basis of risk if the return is 10% in all the cases? So return is same now in all of them. Basis of risk only. FDR issued by an NBFC, a bank FDR, a long-term government security. All are equal since the return is same. So what should I place yourself in the place of this person? What will you choose? FDR issued by NBFC or bank FDR or a long-term government security? See here, important point, return is same 10% in all the cases. Even this NBFC is giving 10%, FDR bank is giving 10%, government is giving 10%. Or is it that all are equal? So the answer can be C or D. What do you think should be the answer? See here, we are asked to choose solely on the basis of risk. Which one is having the lowest risk? Government security, right? A government's long-term government security will be chosen. Why? Because it is having the zero risk. That is called as sovereign. Any country's government is called as a sovereign government. Okay, democratic government is called as a sovereign government. So the security on this democratic government is always, or sovereign government is always with highest security, and the risk is zero. Okay, so I'll be choosing this C. Which of the following is correct statement? Lower the risk, low the risk premium. Lower the risk, higher the risk premium. Higher the risk, lower the risk premium. Lower the risk, no risk premium. What is the answer? Lower the risk, low is the risk premium. Is it so? Suppose if the risk is low, then the risk premium will be lower or higher? What do you think? If the risk is low, what do you think? The risk premium should be lower or higher? Let me see how many of you can answer this. Yeah. This is a basic question for your BFM. So the answer is correct. Only A. Lower the risk, lower is the risk premium. See, your logic is very simple. Low risk, I'll write it over here. Risk, no, here I'll write it because here I'm having a lot of space. Risk. And second is premium. Premium means what? Premium means the charge. Premium. What do you mean by this charge? I'll give you a simple case. Okay. Let me ask you, insurance. Insurance for age of 20 years and insurance for the age of 60 years. Where the risk is higher? Suppose if a person is having 20 years age or somebody is having 60 years age, where the risk is higher? So here the risk is low, right? And here the risk is high. So look logically also, this insurance premium for these two persons, insurance company will charge lowest premium for this person, lowest. And for the 60-year person, firstly it won't give any insurance. No insurance, right? It won't give any insurance. But if it gives, somebody insists, okay, that no, I want the insurance at any cost. In that case, the premium charge will be too high. Too high. Okay. So that is the case. Low risk, low premium. High risk, high premium. That is the basic logic, isn't it? Management of risk within the bank is to be the major concern of. So management of risk in the bank is a major concern of whom? Top management, senior management, middle management, and operational management. Major concerns here. Management of risk is actually the job of everyone, right? So obviously it is the job of everyone. The one who is working in the bank needs to manage the risk at his or her desk or his or her whatever that department is, right? But this question relates to something else. This question relates to major concern means who is here. Importantly remember, as you go higher in any bank or any company, mainly let's say bank only, as you go higher in any bank, the work divides like this. How does the work divide? See here, responsibility is on the top. Responsibility, okay, that is on the top. And at the bottom, transactions means working, practical working, transaction. So if I am at the bottom level, I am at the lower level now, working over here. So my transaction will be higher over here, right? And responsibility will be less. It won't be zero. Otherwise somebody will say zero. It's not zero. So it goes like this. As I move above the transaction to the responsibility level, my responsibility goes on increasing. Okay. So my responsibility over here will go on increasing like this, and transactions will go on decreasing. So at the responsibility level or at the top level, my responsibility top, this is top. At the top level, my responsibility is highest. Okay, but this is for top level. Top, you can write it here also, top level, and this is for the bottom level. Okay, so as I go higher, my responsibility goes on increasing, but my transactions go on decreasing. Okay, so my transaction level will go on decreasing and responsibility will go on increasing. So now again coming back to this question, management of risk within the bank is a major concern of, basically remember, it's a major concern of top management. Okay, why top management? Because they are only concerned with the responsibility part. Does the top management do any transactions over here in any bank? No, right? So it is a major concern of theirs. Management of risk begins with mitigation of the risk, identification of the risk, controlling the risk, and quantification of the risk. See here, in the paid classes I have taken in details about this class, and again we are having one more paid batch coming up for BFM. Join this immediately, because there I have taken the complete process of risk management. Always remember, first it is identification of the risk. Okay, identification. Once you identify, then you quantify it. Quantify, that is step number 2. Step number 1. There are total 4 to 5 steps in this. Then control mitigation, right? So management of risk begins with what? Just now I've told you, identification of the risk. Step number 1. You have to first identify the risk, whether the risk exists or no. That you have to know first, isn't it? Usually the risk management organization in a bank consists of board of directors, risk committee, risk management committee to board, senior level executives committee, risk management support group, and all of the above. So what does it consist of? Okay, let me explain. Again, I'll tell you, join the paid classes immediately. Okay, if you don't know this answer, join the paid classes immediately. There we have taken it almost 3 to 4 times, this same topic. So firstly, always remember, in a bank, the main concerned party is board of directors, top level. They are the concerned persons for anything which happens in the bank. Below them works RMCB, Risk Management Committee to Board. Okay, RMCB. Below them works the Senior Level Executives Committee. Senior Level Executives Committee. Okay. Now this Senior Level Executives Committee consists of senior level. I won't write the full form now. Full thing. Okay. In this Senior Level Executive Committee, there are 3 committees. Okay. One is ALCO. Second is CRMC. And last one is ORMC. Okay. Now what is the ALCO? ALCO is for management of the market risk. CRMC is for the credit risk. ORMC is for the operations risk. And below this, then works the support group. So support group will always support these. Support. That's why the name is support groups. Okay. So this is the sequence. Board of directors, risk management committee, senior levels, and this support group. So what is the framework then? The framework is all of the above. Okay, all of the above is the answer. Got it, everyone? Clear the concept? This concept should be very clear in your mind. Okay, shall we move on to the next one? Okay, next question. Which of the following has the responsibility for implementation of risk and business policies simultaneously in a consistent manner and decide on the business strategy to achieve these objectives within the bank? Question is a difficult one. Okay. So which of these following has the responsibility of, it's a two-edged sword, you can call it. Okay. What are the two edges? Implementation of risk and business policies over here. Okay, that is point number 1. And second, simultaneously in a consistent manner. So both risk and business policies. So if you want to contain this, go to the lowest risk, business will be affected, right? And if you want to get the highest business, risk will be affected. So that's why it's called as a two-edged sword. Okay, so simultaneously in a consistent manner and decide on the business strategy to achieve these objectives. So who has this? Board of directors, risk management committee to board, senior level executive committee, and risk management support group. Who has the responsibility of implementation? Okay, implementation is the job of which level person? Is it of the board of directors, or is it of this RMCB, or is it of the senior level? Yeah, think over it. It is? Everyone? Yes, it is. Remember, board of directors formulate the policy, formulate the policies. Okay, board of directors do formulate the policies. Then RMCB is the committee working below the board of directors. It gives them the suggestions. Okay, and number 2, whatever board of directors think over it, think of various risk factors, its job is to penetrate it to the lowest level. But the implementation part lies at the executive level, that is senior level executive committee. Senior level executive committee has the job of implementation. All these in this senior level executive committee, you have all the three. What? ALCO, CRMC, okay. ALCO, CRMC and ORMC, right? CRMC, ORMC. Okay. So these three committees together have the job of implementation. Okay. All the transactions undertaken by the bank have one or more of the following risks. So all the transactions, all. Now you are talking of all means it is related to cash clearing transfer, account opening, loans, any type of loans, forex, anything you call it under the roof of banking. Market risk including liquidity and interest rate risk, credit risk including default risk, operational risk, and any of the above. Think over it. Let me see in the comment section what are the answers. Yeah. Now it depends. See this. Suppose if you are dealing in forex or securities trading, then here you will be having forex. Okay, forex. I'll give you simple examples. Forex. Then you will be having the market risk. Suppose if you are dealing with loans, you will be having the credit risk. Suppose if you are dealing in any of these now, loans, forex, or even the liabilities, deposits, then you will be having mainly this operations risk, right? So all these transactions are a part of banking transaction. So your answer will be any of the above. All the banking transactions shall have one or more of the following risks. That is, either it can have market risk or credit risk or operations. Now see here, I have given here the word as forex. It doesn't mean this market risk is only related to forex. I have given here credit risk for loans. So it doesn't mean only for loans. Credit risk is for loans as well as others, means for securities also. Operational risk can be for loans, deposits, forex, any transaction, treasury. Okay. A bank branch sanctioned a term loan of rupees 10 lakh for a period of 7 years at 3+ base rate of 9% of the bank. The funding of the loan, let's cancel this, 3+ base rate. Okay. The funding of the loan is from a 3-year deposit at 7%. Which of the following risk this transaction is associated with? So 10 lakhs is sanctioned, okay, as a loan. It is for 7 years at 3% plus base rate. So what is the base rate? Base rate means nowadays here, let's change this from base rate to repo rate now, because nowadays we use repo rate. So 3% plus repo rate. Now funding is from 3-year deposit at 7%. So my loan is for, now look at it, loan is for loan and this is deposit. Okay. My loan is for 10 years, 10 lakh 7 years. Okay, 10 lakh and 7 years. My deposit is for, the amount is not given, so it is same 10 lakh and it is 3 years. Now this loan rate is what? Loan rate is base rate plus means repo plus 3, R repo plus 3, and this is 7%. This is fixed. Now the bank is facing what? This amount is same, but what about this year, 10 year? So it will face this funding risk, time risk, liquidity risk, all of the above. Look at the question properly. Okay. Let's tackle one by one. Now the deposit is for 3 years, loan is for 7 years. So after 3 years, the person who has deposited the money will come back for the funds. So that time you won't be having the money because it is given for 7 years. So you will be facing what? Liquidity risk. Right? Similarly, this funding risk. Why funding risk? Now funding risk means how to obtain the money. So this after 3 years you will be facing this funding risk also. Now what the time risk? Time risk also you will be facing, because after all the durations are different. Similarly, for this repo plus 3 and 7, here also you will be facing the funding risk. So funding risk will be affected over here because of this time also and because of this rate also. Because if the repo rate tomorrow decreases or increases, then your bank will be in a problem depending on whether it's above 7 or below 7. Okay. So all of the above is the answer. The bank will be faced with all the types of risks. Okay. Funding, time, liquidity, all of them. A bank branch sanctioned a term loan of 10 lakhs for a period of 7 years at 3%. Is it the same question? No. No. 3% plus base rate. Let's consider this repo again of the bank. Okay. The funding of the loan is from 3-year deposits here. Basic question remains the same. Only the risks are changed. So the bank will be faced with what? Again go back to this. Okay. So I'll just copy this and write it over here. Loan and that deposit, right? I think so. The amount is same, 10 lakh, 10 lakh. Here it is 7 years, here it is 3 years, and now here it is repo R plus 3 and it is 7, right? So now what are the risks the bank is facing? Basis risk, operational risk, reputational risk, and all of the above. Again, many of you are in typing this as all of the above. Many of you are typing this all of the above because we are in the habit of typing all of the above. We feel that basis, operation, everything is there. But remember, in this case, operational risk is inherent to each and every transaction of the bank. It is inherent here. Operational risk will be there in your savings, current, FD, loan, treasury, trade finance, everywhere it will be there. So don't consider that. Reputational risk is separate. If something comes in the newspaper on any web portal about your bank, bad, and that affects the bank's overall stature, then it's called as a reputational risk. Here you will be faced with basis risk. Okay. What is basis risk? Change in the rate of interest for the loans and deposits in different magnitudes. Now in this case, if you consider deposit rate is not changing at all, it is 7%. But the loan rate is changing, repo plus 3. So repo can be anything. Okay. So that was it about the session. Now before going, as I promised, I'll show you how to join the batches. Go to Adda 24/7. I'll always suggest you to go through the app. In the app you get 1% extra using the coin systems. Okay. Go to JAIIB and CAIIB. JAIIB and CAIIB. Click on CAIIB November. Okay. Click on the crash course. Ebooks, test series, online live classes, expert faculties, interactive classes, recorded videos, everything you are getting. At what cost? Click on buy now. Put the code Y432. Y432. Click on apply. 77% discount you are getting plus 1% extra using the coin systems. So you are getting huge discounts. In fact, you can join the Mahapack also. In Mahapack, if you join, you get multiple batches, 15 plus batches per subject, and you get marathons, previous marathons also. You get elective subjects. Everything you are getting. Okay. So join immediately and at the same cost. Okay. Use the code Y432. Never forget it.